don't really sit down and coldly analyze the facts. There are people on one side of the political aisle that think it's a terrible idea, and people on the other side love it. But it's really their emotional makeup that makes those decisions. So what are the town meetings for? They're there so people can release that anger that's built up from the negative social mood that's been building ever since 2007, and in other ways since 2000, way back at the start of the decade. So if this is only part of the way down, and this is very strongly our opinion, and we've got another big and more powerful downward wave to come, then I think there's no question that you're going to see very major examples of social protest, anger. But it could come out in many, many ways. I think there are going to be separatist movements within from some of the states, and possibly even within some of the states. And so you're going to see some interesting political developments, that's for sure. If you want to be a politician, you don't want to be in office during this period. You want to get elected at the bottom.
Let's talk about the political side of socionomics, since you brought it up there briefly, Bob. The move to greater socialism or fascism or communism or whatever you want to call it that we are currently experiencing with regards to politics. You know, isms tend to be very bad, right, with regards to politics. Will this pick up momentum during this cycle?
Well, definitely. But I want to make something clear. What bear markets seem to create in terms of social positioning is polarization. During the bull markets, people tend to be very middle of the road. Think of the Eisenhower years going through the Kennedy years, or think of the George Bush 1 and Clinton years. You know, the Democrats were pretty middle of the road, and the Republicans were pretty middle of the road. They hardly were any differences between them. The further down you go, the more polarization you get. Governments tend to get very authoritarian, no matter what the ism is. They try to control your life more and more. But that's not the only thing that's happening. It's only one side of the pole. On the other side, people start rebelling. And they say, we've had enough. We're not taking it anymore. At the end of 50 years into a bear market, after the South Sea bubble burst in 1720, they were throwing tea off of ships in New England. And so that's the kind of thing you get. You know, King George was upping the taxes, and the colonists were saying, we don't want to pay them. And I think we're going to see exactly that. We're at the same degree of a bear market. They're going to be pushing tax rates up tremendously, I think, and at the same time, you're going to have strong reactions to that. So it'll be one of those times where somebody's going to probably write a history book about the events. It won't be boring.
During this cycle, let's expand on that just a little bit. Are Americans at a tremendous risk or greater risk of losing our freedoms in this country and our republic?
Definitely, but as I said, it's also going to perk up the other side of the spectrum. There's no predicting, in my view, which side is going to win. Many times the authoritarian side wins. A good example would be the bear market of 1917 when communists took over the government of Russia. 1949 when Mao took over the government of China. Those were end of bear market times, and the authoritarians won. And then you've got the example of the United States in the 1770s and 1780s managing to throw the authoritarian impulse off. So there'll be a conflict about this issue. Which side wins, we'll have to see.
From your paper with Wayne Parker referenced earlier, the authors found that patients with chronic and stable focal lesions and specific components of a neural circuitry that has been shown to be critical for the processing of emotions made investment decisions that were closer to a profit-maximizing viewpoint than control subjects. The brain-damaged patients responded less emotionally to other subjects' behaviors and were thus able to execute a logical investing strategy, end quote. For traders and investors, I thought that was a great lesson, Bob. What are your thoughts on this? Because it really is saying to take the emotion out of it, right?
Well, yes. In fact, what these individuals probably could not discern was other people's moods. We're getting signals from people in ways that we don't even know, facial muscle movements that we can't consciously interpret. Smells are possible. There are new studies saying that people who feel stressed actually smell different from others. We can't know all the ways that we are sharing this mood just by hanging around each other. But apparently, people with certain types of brain damage can't pick up on any of that. So they're more like little computers, and they say, well, here's the data. I guess this is what I should do. But the person who is normal has a very powerful herding impulse. and it's nearly impossible to overcome that. Even veterans in the stock market, traders who take a lot of leverage, can't help but feel pressured very often. But the successful ones figure out how to interpret and ignore or let's say quarantine those feelings into one part of their mind and go ahead and operate, understanding full well that those feelings are an enemy to them. And if you can take it to another step, you realize those feelings are actually helpful because you can feel it in yourself and use them to realize you need to do the opposite thing.
You know, it's interesting, this idea that we're talking about right now, because you may have some traders out there that are less experienced, right, Bob, and they're looking at some of these NASDAQ tech stocks or whatever and saying, you know, the market just keeps going up. Let me go in and grab Cisco because it's going to go up a little bit more and I'll be able to sell it for profit.
Yeah, or people that are buying stocks of completely dead companies like Fannie Mae and GM.
Right, right. And so, but in reality, what you're trying to say to people here, and I'm sort of narrowing down socionomics now in relation to the financial sector, but is that really in reality, these are when you get the greatest dangers with regards to putting dollars to work, correct?
Yes. Whenever the news is great, you have to realize it's a result of the past. It's a result of the past improvement in social mood. Now, just having good news, you know, contrarianism can kill you if you don't have a context, because things were way overdone as far as I was concerned by, 1989, and the market kept going for 10 more years. What you need is a context, and that's what the wave principle gives you, because it'll give you a perspective of when to expect the most extreme sentiment. So when we bottomed in March, for example, we said you're going to see all these things that we just talked about earlier, and people are going to have all kinds of reasons to be bullish. But we didn't say that we were going to see so much optimism that we would return to the manic days of 2005 or 2007. That's not going to happen. And our context tells us it won't happen. Someone who doesn't have the wave principle to judge from might say, well, here we go again. We're going to be right back in the crazy world that we had earlier in this decade. But our context says that's not possible. So at least we have this form or structure or model is a better word, against which to judge the readings that we talked about earlier from how bullish traders are and how bullish the investment advisors are and what that means at this juncture of primary degree.
You were able to call the top of silver when it got over $20, and then, as I said, in last August, you were mentioning that this was going to roll over on the market, and then we had the real collapse come. And then you did call the bottom there in late February, early March. You said this big rally would happen. You've had a bit of a hot hand, is my point here, but now you're getting bearish. Really bearish. And I think what you're trying to say, I guess, to people is you have to, there's a variety of things. It's almost like an art form, isn't it, Bob? Because you're looking at not just sentiment, but you're looking at sentiment, you're looking at wave counts, you're looking at a variety of things for you to sit there, take your money, put it to work and say, I'm taking a short position here now.
Yeah, I call it a craft because there's so many elements to it that you can pick and choose, which ones fit your personality better, which ones you can best put to use. For example, in the silver market, this is a great example. The 5th of August is when the dollar made its low so far. But silver had already topped on the second rally, just above $16 an ounce. And by the time the dollar was making its low, it was bouncing to $15 an ounce. And gold was making lower highs as well. So despite the fact that the dollar got weaker against other currencies, the metals were struggling. They couldn't even get to a new high to reflect that. So I felt that was another extreme indication that the bulls and the precious metals were getting worn out. Now, we haven't proved that yet, although to this day, silver's just above $14. It's well below the $21 high, and it's below the $16 high, and it's below the $15 high. So I see a series of lower tops despite what was weakness in the dollar through the 5th of August. So there are so many aspects to market analysis. It's taken me 30 years to weed out the ones I don't want to use anymore because they don't work or they lead me astray and concentrate on the ones that do work.
Not to hammer this point home, but this was from your piece also addressing these things that we're talking about. Investors must be aware only of the powerful emotions that attend these unconscious impulses and sometimes of the rationales for their consequent actions. If such motivating impulses were conscious, investors would recognize their inappropriateness for successful investing and use reason to buy low, sell high, and get rich. In the aggregate, however, investors always do the opposite, which is a strong indication that the impulses driving their behavior are unconscious. Even individually, most investors, despite years of exposure to financial markets, do the opposite of what they should again and again, end quote. Bob, I just want to tie this. I don't mean to laugh. It's not funny. But I just want to tie this in.